Get in the zone, the Jeff Cohn zone. I I think I'm gonna just introduce you with new old ad jingles. Do you remember which one that was? I definitely screwed up the tune
AutoZone.
of that. Gotta be
Yeah,
a
get in the zone.
classic.
AutoZone. Jay Cohn's always in the zone. You know that.
Yeah. No free ads, but like if AutoZone people are listening and want to throw us some money for our 40 listeners, you can reach us at.
Oh, we're about to boost the
uh,
revenue with our 40 listeners.
oh
Put in
yeah.
the ad right after our icebreaker.
Yeah. Well, good. So happy Friday, Jeff. I know we usually start with an icebreaker. I have a good topic today. Going to talk a little bit about markets and what's been going on with the Fed cutting rates and a little bit of that, but mainly talking about company stock and what to do with that if you get kind of company granted stock. But before we jump into all of that, I believe one of the two hosts on this podcast got engaged recently. And it wasn't me. So congratulations,
Yeah.
Jeff,
Yeah,
on
thank
the
you.
engagement.
Thank you. Like a lot of big commitments, it takes a lot of time and research and due diligence to make sure that you're making the right choice. So, yeah, me and my fiance have been together for over 4 years. I definitely was calling a lot of my family, letting them know. My aunt and uncle both were like, about time, which I knew I was going to get a few of those. It was fine. I
Oh
will
yeah.
say that, she thought it was well worth the wait.
There you go. There you go. Where'd you propose?
We went to a local park just nearby where we live, where we take the dogs every Saturday morning for a walk. And so it was just
Nice.
another routine Saturday morning. It was a beautiful day. There wasn't really a lot of people at the park. We did a couple of laps, and then there's this very long bed of flowers and bushes and kind of like really nice scenery right there in the middle of the park. So it was pretty empty. And, I just looked at her and said, today's the day.
Amazing.
That's
Amazing. Was
it.
she
Yeah.
surprised or?
Yeah, she immediately ran away. She ran. And I was like, no, come back, come back. It's okay.
Yeah.
And I was like holding the ring on down on one knee, and I was kind of like holding it out to her, like, come on, trying to reel her back in. But yeah, she was surprised, completely caught off guard, and then no one really noticed. I kind of, as I was planning this, I wondered like, man, are people gonna like see it and like clap or something? But
Yeah.
no one even
Yeah.
noticed, so we just kind of sat down on a bench and like enjoyed our moment. And yeah, it was a nice day.
Nice.
It's a good way to
I
start
like
the
that.
day.
It's very, very intimate and being close to home is very nice with that as well. And a
Yeah, it's a
place y'all
special
know
place
so
for
well.
us. Yeah,
Yeah.
now even
Yeah.
more special.
It's the happy place. Love it. Well, congrats to you and Sam and congrats on all of that. And excited for what's to come. Have you guys set a date or talked about wedding or what that looks like for you guys?
Yeah, we wanted to shotgun it. Basically go out to the courthouse and just do it the old-fashioned way. In reality, it's just so much that goes into it, and not really something that she wants to do. And I was perfectly okay with that. So yeah, we'll still do like a big party for everybody and have a big celebration, but we
Nice.
plan to keep it pretty trimmed down, and then maybe we can allocate some of that capital to some honeymoon experiences.
There you go. I like it. Any ideas on where you guys want to go?
Yeah, we got some ideas, but
Okay.
I'm gonna wait
Still
until
working
it's
through.
confirmed.
Yeah.
Yep.
Yeah. Love it. Love
Hopefully,
it.
it's several places.
Not. Oh, okay. I like it.
Yes.
I like it. Well, congrats again. I got an awesome topic for the mappers today. Let's get right into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only.
All right. So, like I mentioned, we're going to talk about what options you have with owning company stock. But first, kind of want to give an update on what's going on in the market economy. There's been some moves with interest rates. So I'll kick it to you, Jeff, and kind of let you take it where you like.
Yeah, sure. I mean, just a really quick market update. Equities continuing to rebound and actually hit new all-time highs after we had that volatility in April. Of course, tariffs now are somewhat of an old story. They've kind of gone back and forth. Some of them are being challenged in courts right now. But largely what we've seen is we've not really seen those price increases pass through to consumers. If we look at the consumer price index, the PCE was released this morning. Probably not where the Fed wants it to be. It's not really running at that 2% rate, but it's not really showing an inflection higher that much either. Now you do see it in some goods that you would expect, appliances, electronic goods, furniture, those sorts of things, but it's not really anything that you would expect. It's not really accelerating in a way that creates a lot of fear or has you think that this is becoming embedded or a real problem in the economy. And so what's happened in the background with that is new labor demand and new job creation has really slowed quite a bit. Part of that is because we're, low fours unemployment rate. We're basically at full employment, but we also see just signs that labor demand is weakening, and there's not really a lot of urgency by companies to hire new workers. We're seeing wage growth decline. We're seeing the number of people that are unemployed for longer. We're seeing that number starting to creep up, and we're seeing less people quitting their job, which is an indication of their how they see their prospects in the current labor market. And so we do think there are signs that the economy is slowing. And because of that, the Fed went ahead and cut interest rates 25 bips, kind of saying, I think Powell called it a risk management cut, basically not wanting to get behind the curve as the economy clearly is slowing signs of deterioration. But overall, the stock market continues to be all about this AI and CapEx story, putting in, new power and power sources, putting in new data centers, getting the GPUs from NVIDIA. And it's actually to a point where if you look at GDP, fixed investment is actually growing just as fast or even faster in the first quarter than consumer spending. So it's kind of interesting. We're seeing this dichotomy in the market. We're seeing things split up where consumers are still spending, or that spending is starting to slow down, but we are seeing some of the heavier construction and investment in data centers, and that's helping lift that part of the economy, but also the stock market, which has become concentrated within that trade across a number of sectors.
Yeah, for sure. And I know you mentioned they just cut by 25 bips or 0.25%. Are they expecting they're expecting a cut again in October, right?
That's right. Yeah, they did their summary of economic projections, which they put out every other meeting, and that shows what they expect the economy to do as well as interest rates. And they did pencil in, the median forecast. There's 19 people that give their forecast on this committee. The median forecast had 2 more 25 basis point rate cuts before the end of the year. So that's October and that's December. We'll see. The latest string of economic data has actually shown that maybe the economy is, recent data has been slightly better this week and last week versus the prior, 3-4 weeks ago. But overall, inflation is pretty stubborn and people see that the economy is slowing down. And so I think this kind of creates this new question of what is the Fed willing to accept on an inflation front, especially considering how much pressure there is from the executive branch to lower rates, right? Especially going into the new nominations in 2026. So I think that's something that's very interesting to watch. But clearly, the Fed is starting to cut rates. Equity markets love it. We're still at almost record high valuations in equity markets. We're still at record tights as far as corporate bond spread and high yield bond spread. So essentially, the risk takers in equities are taking risk and it's very expensive. The risk takers in fixed income are taking risk and it's very expensive. And so, for us, we think it's really important to be diversified. We think the S&P serves investors well as the tech and data center and AI trade, and they need to make sure to complement that with other allocations across the market, as well as in other assets like bonds, like commodities. Gold has done really well. And like crypto, which has pulled back recently, but we think actually is setting up for a really nice run over the next couple of years.
Yeah, definitely. And the only other point I would just make there is just that clarification point, and the real most loyal mappers know this, is that the Fed has these 2 mandates. One is looking at unemployment, the other is looking at inflation. And those are the 2 main metrics they're really trying to track. And you've mentioned kind of different aspects which are showing potential weakness on the unemployment front. And that's why they're looking to cut rates. But the reason that they're doing it at 0.25% month over month and kind of waiting and seeing is what they want to wait and see what happens to inflation. They don't want inflation to spike up when they cut a bunch right away And then they're back in the same situation we had in 2022 with really rampant inflation. So they're trying to solve this before it becomes a problem without increasing inflation too much, and kind of going to do that over time as gradually as they can to get to that interest rate level that they think is more normal for the economy.
Yeah, exactly. And it's relative to inflation too. And of course, the Fed is trying to understand, do we have any pressures in the background that could raise the risk of accelerating inflation in the next 12 months? And, obviously we have tariffs, and, tariffs is kind of a clear sign that historically has led to higher prices. It makes things more expensive. We see that not just with imported goods, but also domestic goods, because you increase demand for domestic goods and services if there's a tariff on foreign goods and services. And so we've not really seen that filter through yet, which has some people either celebrating and declaring victory, and other people saying, well, that means we haven't felt the full effects of it yet. And I think that's the key question for the Fed, them going ahead and cutting rates and then penciling in, a higher inflation forecast, but also more interest rate cuts compared to their last SEP, I think tells you that they're more worried about the employment side, and they're happy to, tilt that balance in favor of employment and suffer a little higher inflation. And we think that's probably the new regime going forward. And that's also a good environment for gold, which we've seen, do really well. It's up 44% year to date. And it's, crypto is also, I think, an asset that's going to start behaving in a similar manner as, higher but persistent inflation becomes the new norm. And by the way, we still have this growing fiscal and monetary, stimulus in the background.
Yeah, definitely. And I think next episode, we'll do a deeper dive into everything we're seeing in markets, economy, portfolio, everything, and spend some more time there. But want to really spend a lot of time today kind of talking about people who get company stock, whether it's they work at a Fortune 500 company or they work at any, frankly, public company where they're granted some sort of company stock in manners. There's many different ways that you can be granted stocks. RSUs is very common, restricted stock units. There's a lot of different types of stock options, non-qualified stock options, incentive stock options. There's an employee stock purchase plan, which basically means you can buy the stock at a discount. There's a bunch. I won't.
You can buy stock in a 401k a lot of times. So we do 401k allocations for clients, and I see the single stock in there pretty often.
But I wanted to kind of step back and talk more broadly. We can definitely have that as a topic in a future episode to kind of go through each individually and explain what they mean. But I think it's more beneficial to just talk more generically in terms of, when does it make sense to keep company stock? When does it make sense to maybe look at, hey, maybe we should be diversifying a little bit more? And so I kind of wanted to talk more on the portfolio management side of things. And there's kind of a rule of thumb that I've heard, but I want to flip it to you, Jeff. But I've often heard that rule of thumb that you don't really want to be invested more than 10% in any one company.
That's the rule of thumb that I use. I don't know if there's like a lot of math behind that as far as like tracking the contribution of variance of your portfolio from an individual holding, and when that contribution is at a sufficiently low amount, if you're feeling me. Like, that's getting a little technical, right? But like 10% to me sounds right. I think it's just you're opening yourself up to so much risk when you do it, and it's risk that is, completely. It comes out of nowhere, right? It really can come from a lot of different sources, and so a lot of people, I think, they get a little too overconfident, and they know the business, right? They work in the business a lot of times, and so they want to get that exposure. I think the 10% too, though, what you need to include and consider is how much of your income prospects are related and correlated to this business versus just your net worth.
And that was one of the big points I was going to make. Oftentimes when I work with a client and they have company stock, it's a point I make, and I think kind of hits home very well. Like, if the company you're working at is doing very well, there's other ways that you're going to benefit, whether it's bonus, whether it's increase in pay, whether it's future opportunities that you may have compensation wise outside of just your equity. If the company's doing poorly, then you're kind of in a situation where you're hit on two fronts pretty bad. You own the stock, and potentially you're not going to get the same bonus you usually do. Potentially there's layoffs in a department. You could be in a situation where your company is doing poorly, the stock price is reflecting that, and they're having to make changes employment wise, and you're really kind of taking a double risk. You might be at that 10% or a little bit higher than that, but I'd argue you're taking more risk than that with that company stock in that situation.
Yeah, I think so too. I mean, like the way that I would typically break this down, if you're thinking about portfolio management, evaluating risk to a stock, you're looking at it from a macro perspective first. What are the big macro cycles and influences on stock prices? And the good news is those mostly affect most of the stocks the same. Obviously, banks are affected by changes in interest rates a little more than, say, consumer staples companies or tech companies, but overall, they're positively correlated to growth and corporate earnings and the overall economy, right? And then you break it down to a smaller level, which is the industry level. What's affecting the energy sector right now? Well, that's oil prices, right? Well, what's affecting AI and technology? That's the build out of data centers and the purchases of GPUs, right? And so you have different factors that can affect kind of the industry level risk, which as those factors change, really just affect the companies within that industry. So you can kind of protect yourself if, say, the AI story starts to turn sour by investing outside of those sectors and you achieve diversification. And then you have at the smallest level, the individual security and the individual stock, where it's things like a change in management, issues with their accounting practices. Maybe they lost a large customer. Maybe a specific supplier just increased prices on them because they have a lot of power. Maybe a new competitor came in and disrupted one of their products or made it obsolete, right? And these kind of get really specific and detailed down to the investment thesis in a way that it's so specific to the company that it's also easy to diversify away from it, right? If you're really worried that a company is going to lose a big customer and you want to protect against that risk, it's really easy to just buy a whole bunch of other stocks. And what's the correlation between each of those losing their biggest customer is all zero, right? It's completely unrelated. And so you match those all together and you can achieve diversification. And, I think a lot of financial literature would tell you that around 30 stocks is what you need to achieve diversification in a portfolio, to where those individual stock events, those idiosyncratic events, don't really have a large impact on the total portfolio once you get to that 30 stocks.
Yeah, definitely. And kind of zooming out, another way I kind of frame when people get company stocks is kind of the same way I frame it when people inherit money that's invested in a certain way. And it's basically, let's say you have stocks that vest at your company and it's worth $3,000, for example. If you were to get a $3,000 bonus in cash, would you use that to then buy your company stock? And if the answer is no, then I'd argue it doesn't make a ton of sense to hold it once it vests. And yes, the response I get is, but taxes. We'll talk about taxes here in a second. It's different for the many different grants I mentioned. Sometimes you're able to purchase at a discount. In different situations, it's going to be taxed differently. But ultimately, my opinion is typically to really diversify away from the company stock that you're granted as it vests for the most part. I think there's situations where you can continue to hold a portion of it, but I do think it is a common thing that people hold way more than they should. And another thing that people don't really realize is that they're holding way more or already taking on that risk because they have stock that vests, sure, but then they have a scheduled outline of future stock that they're going to get that's going to vest. It's unvested at the moment. You own that stock and you're going to own that stock. We can't sell that yet. So that stock you already own, you're already getting the benefits of if the company continues to do well. So I would argue that's another reason that you're already in that company pretty significantly. That stock is going to continue to vest. If you continue to work there, you're going to continue to get grants or different rewards of future incentives from the company, which I think should be thought of more as bonuses that a lot of times make sense to sell. Sometimes that means paying a small capital gain and then rediversifying that into the broader portfolio or the broader market. And obviously how you diversify that depends on your goals. If you're trying to buy something in the short term, like a house, then maybe it makes sense to be a little bit more conservative there. If it's for retirement, maybe it makes sense to be aggressive, sure, but that doesn't mean you need to be aggressive in a non-prudent way in one individual stock. Get overall market exposure and still take risk, but have higher upside or spread out that risk across industries, across companies, across countries. I think is always important.
Yeah, I think so too. I mean, the winners in the market, they kind of hand off the baton year after year and cycle after cycle. And so if you're, really invested in one company, that means you're also invested in one industry and one avenue for growth and one potential for return and all these different things. And I think from an investment portfolio perspective, you want multiple sources of return. You want variety of situations and scenarios where your portfolio does well. And if you're putting it all in one bet or a significant portion in one bet, then it's really going to depend on how that particular scenario plays out, right? And that's just usually, not only it's risky, but also you do better when you don't invest that way, right? Because it's the top performers really are changing cycle after cycle so often.
Yeah. Another point I wanted to make is just, I guess, kind of the difficulty of owning a single stock and kind of some psychological fallacies that some people may have. And the fact that if you own an individual stock and you're scared to sell it once it vests, or even if this isn't company stock, you just own the stock, you're scared to sell it because you'll have to pay taxes. When are you going to sell it? Because if it goes down, I know you're going to say, oh, it's down right now, I don't want to sell at a loss. Like, I know it's going to rebound. And then when it comes up, if it goes up beyond this point, it's going to be more taxes that you have to pay. And I've worked with a lot of clients who were fortunate enough. I live in Atlanta. So a lot of times I've seen people who worked at Delta for a while, Southern Company, Coca-Cola, they've retired there. And they have this company stock that they've had for so long. And it's at this very low cost basis. Cost basis is the amount that you purchase that stock for. And it's at such a low cost basis compared to the current value that if they were to sell it all, it'd be a huge tax gain. So if you think that the company is going to appreciate over time, the tax liability that you'd have to pay will only get higher and higher. I'd argue there's never going to be a great opportunity for you to really sell.
Yeah. People hate paying taxes. I think people love making money though. And so I think people need to start taking the two together. Nobody likes to gain weight, but a lot of people like to eat sweets. So sometimes it's the price you pay and you have to accept that. We don't live in la land. So, we can't just expect not to pay taxes when we make money. Right. But at the end of the day, I think the way to avoid that, the way to kind of take the emotional bias out of it, any kind of an endowment bias, maybe like you like it because you have it kind of bias. You see a lot of executives do this where they'll put in a plan with the SEC to sell a prearranged amount of shares at specific points in time, right? And they do that for the same reason that we're talking about, where they don't want to have all their eggs in one basket. They like the prospects of their company. But, executives at Meta and Microsoft and Apple still routinely sell shares in those companies because they don't want to build up too much of a stake. And they want to make sure not only they have liquidity for their lifestyle, but that they have other investments across their portfolio. And they do that in a very structured, emotionless way where it's all preset. And so I think, for a lot of executives, they get these, stock units or they get awards. They really know when it's going to happen. They know the price, price thresholds and that they need to hit. I think they just need to have a plan to, when do I want to sell this? When is it going to be too much? When the kind of big lump sums, big awards are going to happen. And you can prepare for that, right? And if it's going to be a big tax hit, then maybe speak with somebody about doing some tax loss harvesting or some other strategies that can help build up a tax loss base. Because as much as, taxes are a part of making money, there are ways that we can minimize them. And so we certainly do want to do that.
Yeah, definitely. There's always things you can do within your overall portfolio to find opportunities, hopefully, to minimize taxes. And it's a great point about the executives. Really hit home for me right there on the you can't eat sweets if you're trying to lose weight, because I'm trying to cut that right now. It's tough. It's tough.
Yeah. Hey, I want that investment with no risk, 10% return a year, fully liquid, no taxes, please. Yes.
There you go. And I think back to the taxes point, you have to pay taxes when you make money. That's the way it is. The government wants their slice. Once you make money, to make it real, you got to make that sale and pay taxes. And then after you pay taxes, you still made money. It's not like you're taxed more than you made. That wouldn't make sense. It's a percentage basis. And so you have this gain on paper. Make that real by selling it, paying the taxes, and then diversifying into other positions. And those are hopefully going to go up as well. And you want to look for opportunities for when it makes sense to rebalance those as well. I know that's something that we're always doing for our clients and looking out for. But I think if people do things on their own, it's something that sometimes is missed. And personally, I don't know how I could possibly even do that on my own. Like it takes a lot. Like it's you need a team, kinda. So
Yeah. Yeah. We have tools that help us do that, on our side and do a lot of the math for us across the portfolios. But yeah, there is a lot of work. There's a lot of monitoring that goes into making sure that you have a balanced portfolio. Balanced portfolio is not just owning a lot of tickers. It's owning a lot of investments that behave differently. I say that a lot to our clients, and everything that we have in our portfolios, serves that purpose. And I think that's what you have to ask is, this stock, what purpose is that serving in my portfolio? And is it correlated to anything else? Do I already have exposure here? Right. And, a lot of clients, they love, joining meetings and say, do I have anything in tech or AI? I keep hearing about NVIDIA. Why don't we have something in there? And I say, look up the holdings for the S&P 500. NVIDIA's over 7% of that. And the rest of those holdings are all tech names that are also tied to the same theme. Right. And so sometimes you just decide, I have enough exposure to this area, and you want to have, somewhere else. And I think that this single stock conversation really fits in that. A lot of people, again, I said it from the top, they have these high aspirations. They want to make a lot of money. They really believe in their business and what they're doing. They see the inside. Maybe they see what they see as improvements, but there's so much going beyond the scenes that's out of their control, could be out of leadership control, executive control, what have you, that can impact the price of stock. I mean, I've seen it for people that had, shares of like oil companies in their 401ks. And during COVID, they were really kind of caught off guard when oil prices literally went negative. You're having to pay people to take and store your oil for you. And these oil companies sold off, right? And they're looking at their 401k like, oh, now I'm down 50% on this stock. And it was a quarter of my portfolio. What do I do? And that's a really tough situation to be in. And I can tell you right now, a very easy, foolproof way to never be in that situation. And it's to never have that much allocated to a single stock.
yeah, and I think you make a good point. There is you work at this company, you believe in that company, or you believe in their prospects. You have an inside look at it, and oftentimes it's something that you want to invest in. And we're not saying you need to sell all of it. That's definitely, don't listen to this and that be your takeaway. I just think coming up with a standard percentage, like we use that 10% example, but whatever that percentage is for you, whatever you think works for you, I think choosing a percentage of your overall portfolio, the amount that you have invested, and sticking with it. Okay, my company stock is appreciated. Instead of the 15% I wanted allocated to that because I'm super, super bullish on my company, I'm at 25% now. I'm going to trim 10% and throw it in the S&P 500 or whatever it might be. So I think just, you mentioned emotionless with kind of how the executives do it. I think that's a really, really good way of putting it, and a really good standard to follow if you're able to do that.
Yeah, for sure. For sure. Fun discussion.
Well,
it actually does come up quite a bit, and not just for company stock, just for some clients that want to own just a lot of a stock. I've seen it too, where they inherit a stock that maybe like their father believed in and he thought this was a great company. And so they feel almost obligated, right? Beholden to hold on to that. And, sometimes it is tough to kind of explain, hey, I see what you're saying about this stock, but if this sector has a downturn, then what happens? And those are the conversations that you have to have, and they're not easy to have on your own, which I think is one of the benefits that we provide to a lot of our clients.
Yeah, and our mappers, of course. Can't forget about
and our mappers, of course. They they get the free listen in.
There you go. Well, Jeff, appreciate you as always. Congrats again on the engagement, and we look forward to next episode.
Yeah, Yeah, thanks for having me on. Can't believe I got her to agree to spend her life with me. But I must be a convincing guy.
I guess so. All right.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov.